Welcome back to Investing Talk, a podcast.
Today we're looking at Intel.
As usual, before we start, subscribe, like, and comment on this video to support the show.
It really helps the algorithm find us. And honestly, considering the chaotic news cycle we woke up to this morning, you're going to want to stick around for this one.
Absolutely. Let's set the scene right away because it is Friday, January 23rd, 2026.
And what a Friday it is.
If you've looked at your portfolio this morning, specifically if you hold any semiconductor stocks, you might be feeling a little whiplash.
Whiplash is putting it mildly. It's more like the roller coaster just flew off the rails. Intel released their Q4 2025 earnings last night.
And the context here is everything.
It is. Leading up to this, the stock was on an absolute tear. It posted, an 84% gain through 2025?
It was the comeback story. Everyone loves seeing a fallen giant get back up. But then the market reacted violently.
And I mean violently.
To the new Q1 2026 guidance, we're seeing a huge sell-off, panic everywhere, and just a lot of confusion.
Which brings us to the core conflict we really need to unpack today. We have to figure out, is this the real triumphant return of the American chip giant under Lip-Bu-Tan?
Or is it just another classic value trap, where investors get burned by promises that never quite materialize?
Right, because this isn't just about a chip stock anymore. If it were just about quarterly revenue, this would be boring.
This has become a massive geopolitical play. You've got the whole national champion narrative, the desperate push to the 18A manufacturing node.
And huge government involvement.
Yeah.
Exactly. So what here is enormous. We are looking at whether the United States can actually onshore advanced semiconductor manufacturing.
Intel is the poster child for that whole idea.
It is. If Intel fails, you could argue the entire U.S. chip strategy fails with it.
So let's get into the numbers, because confusingly, on the surface, the actual Q4 results from yesterday looked pretty good, didn't they?
They did. And that's what makes this sell-off so psychological.
Huh?
So let's look at the data. Q4 2025 revenue came in at $13.7 billion.
Which actually beat the expectation of $13.4 billion.
A solid beat. And the earnings per share, or EPS, which is just how much profit is attached to each share you own, that was even better.
Yeah, they hit 15 cents, which was nearly double the 8-cent forecast. So technically a beat on the top line and the bottom line.
And if you zoom out to the full year, 2025 revenue hit $52.9 billion. But the real story is that the turnaround is finally showing up in the profits.
Net income from continuing operations was around $4.27 billion.
That is a massive shift from the red ink. I mean, the billions in losses we were seeing just a couple of years ago.
But when you dig into the segments, it's a bit of a mixed bag. Not everything is working, is it?
Not at all. The data center and AI segment is the star right now. It grew 9% year over year to $4.7 billion.
And that's critical because it proves they're finally catching that AI wave that NVIDIA has been riding.
For a while, investors were worried Intel was totally locked out of the AI data center build-out.
But then you look at the legacy business, the client computing segment, so basically the PC business.
The chips in your laptop.
Yeah, that was down 7% year over year.
Which is a little concerning, since historically, the PC market is their cash cow. It funds everything else.
Yeah.
But I think the most impressive metric isn't revenue. It's the efficiency.
The Lip-Bu-Tan effect.
Exactly. The CEO who took over to right the ship. The cost discipline has been intense. Operational expenses dropped to $17 billion in 2025, and they're targeting $16 billion for 2026.
And the bleeding we saw on the gross margins, it stopped.
It has. Margins recovered to 40% non-GAAP in Q3. In the chip world, that is the magic number. If your margins drop below 40%, the market thinks your business model is broken.
Okay, so operations are tighter, but let's talk about the war chest. For a company facing so much skepticism, their bank account looks incredibly healthy.
It's what we call a fortress balance sheet. They are sitting on over $30 billion in cash and short-term investments.
That's a staggering amount of liquidity. But it's not just their own money, is it? This is where that whole national champion idea becomes a financial reality.
No, and this is where the thesis gets so unique. The external funding de-risks the whole thing. You've got $8.9 billion from the GFES Act in direct equity.
Let's pause on that. Direct equity. This isn't a loan. It's not a grant.
Nope.
It means the U.S. government effectively holds a 10% stake in the company? They are a shareholder.
Exactly. And when the government is a shareholder, they generally don't let you go to zero. Plus, you have a $2 billion investment from SoftBank.
Which is known for making huge, aggressive bets on the future as AI. That's a massive vote of confidence from so-called smart money.
And don't forget the secure enclave defense contract. $3 billion. The U.S. military needs these chips.
Yeah.
They can't rely on chips made in Taiwan for national defense.
So you have the cash, the government backing, defense contracts, but those are safety nets. They aren't growth drivers. What's the actual competitive advantage? What's the moat?
The moat is supposed to be the IDM 2.0 model, the whole idea that you design the chips and you build them. And you build them for other people, too.
Right. Unlike AMD or NVIDIA, who just design.
But specifically, the real moat is the 18A process node. This is the 1.8 nanometer technology. I mean, we're talking about transistors so small, they're approaching the size of a DNA strand.
And this is the most advanced silicon made on U.S. soil.
By far. This is what powers the new Panther Lake processors. If 18A works as advertised, Intel leapfrogs the competition. They could potentially even surpass TSMC. That's the entire bet.
Okay, so if 18A works, the stock is cheap. If it fails,
This company is in serious trouble.
all right, let's pivot from that to the charts. We need to talk about price action because 2025 was just a wild ride.
A trader's dream. The stock rallied roughly 84% through the year. And just leading up to this earnings release, it surged over 11%.
It was parabolic. People were piling in, expecting a blowout. FOMO was in full effect.
And then, bam, that sell-off because of the guidance. It's painful if you bought at the top yesterday, but if you look at the trend, the stock has still been forming higher highs.
So structurally, over a 12-month period, the uptrend is still intact.
For now, yeah. We saw a golden cross configuration recently.
For those listening who aren't technical wizards, can you explain the golden cross? Why do traders care?
It's when the short-term moving average, usually the 50-day, crosses above the long-term average, the 200-day. It just indicates that short-term momentum is accelerating faster than the long-term trend.
It's usually a very bullish signal.
Exactly. It confirms the turnaround is real, and the volume backs it up. We are seeing clear institutional accumulation.
Meaning the big funds are buying in clusters. They aren't just nibbling. Retail investors panic sell. Institutions accumulate.
But let's play devil's advocate on the price. I mean, is it expensive?
That is the big debate. At one point, it was trading around 77 times forward earnings.
The 77 times.
Yeah.
For a hardware company, that's NVIDIA-level pricing. That requires perfection.
It does, but, Melius Research argues that even with that high multiple, it is so cheap compared to TSMC when you factor in the growth of the foundry business.
So you're paying a premium for today's low earnings, but a discount for future potential.
You're buying the growth of the foundry in 2027, not the PC chips of today.
Okay, let's shift gears to, let's call it the psychological battlefield. What is the market mood right now?
I would describe it as somewhat bullish, but extremely jittery. The latest market context score is hovering around 0.30, which is positive, but fragile.
It feels like everyone is just waiting for the other shoe to drop. But there are some huge hype drivers keeping the optimism alive.
CES 2026 was a big moment. The launch of the Core Ultra Series 3 processors was really well received. They're powering over 200 different PC designs.
And the ASIC business, the custom chips, is hitting a $1 billion run rate. That's not nothing.
It's not. An ASIC is an application-specific chip. Big companies like Microsoft or Meta want custom silicon. Intel doing $1 billion in this space validates that they can make chips for others.
And the analysts seem to be buying it. Melius Research upgraded to a buy with a $50 target.
KeyBank also raised their targets, and Seaport upgraded to buy, specifically citing sold-out server CPUs. I mean, when your product is sold out, that's a good problem to have.
There's a political element, too. CEO Lip Bhutan had that high-profile meeting with President Trump.
That was crucial. It just reinforced that national security narrative. It signaled that the White House has an open door for Intel.
But there are always rumors. What's the chatter on the street? Any mega whales?
Well, there are these persistent rumors that NVIDIA might hedge its bets by using Intel Foundry, for U.S. regulatory reasons.
Wow. That would be a game changer. If NVIDIA starts building with Intel, the stock could double overnight. It validates everything.
And there's also chatter about Apple maybe using the 18A process for M-series chips around 2027. Apple hates being dependent on just one supplier like TSMC.
Okay, but we have to stress, everyone listening, these are unconfirmed. These are just rumors.
Totally unconfirmed. Do not buy a stock based on a rumor. And on the flip side, the stalled acquisition talks with Samba Nova, that's a dampener.
All right, let's take off the rose-colored glasses. We have to talk about why the stock tanked. The bear case.
The Q1 2026 guidance shock. There's really no other way to put it.
Let's hammer this point home. This is why people are panic selling. What were the numbers?
Q1 revenue guidance came in at 11.7 to 12.7 billion, a huge miss. But the real kicker was the EPS.
Projected to be near zero. A nice round $0.
Zero profit.
Right.
For the entire first quarter.
How does a $50 billion company make zero profit? It sounds incompetent.
It's about inventory and physics. They've depleted their inventory buffers, and now they are shifting wafer production over to servers.
Okay, why does that matter? Why does switching to servers kill profit for a quarter?
Because server chips are larger and way more complex. Think of a silicon wafer like a pizza. You can cut lots of small slices, your PC chips, or just a few huge slices, your server chips.
And the server chips take longer to bake.
Exactly. So you have this period where the factory is running, expenses are burning cash, but the finished goods aren't coming out the other side yet. It creates an air pocket in the earnings.
It's a timing issue, but a painful one for investors.
And then there's the execution risk. This is the ghost that haunts this stock. Intel has a history of promising big and delivering late.
The yields on 18A and 14A reports say they remain below expectations.
And yield is the percentage of chips on that wafer that actually work. If you have low yield, you're just throwing away half your pizza. It destroys your margins.
So if they fail to ramp high-volume manufacturing because the yields are too low, the thesis collapses.
Completely. The moat evaporates. And it's not just internal problems. The supply chain is messy.
A global tightening of DRAM and NAND memory. That squeezes the PC segment because memory costs go up and Intel's profit on the whole package goes down.
And competition isn't sleeping. AMD is relentless. They're still taking share. TSMC is moving to 2 nanometer.
Intel has to be perfect just to catch up.
Okay. So we have a Q4 beat, a disaster Q1 guide, a fortress balance sheet, and terrifying execution risk. What's the final score?
If I have to give it a score, I'm landing on an 8 out of 10.
An 8, really. Even with the 0 EPS guidance. That seems generous, given the risks.
I know it sounds high, but you have to look at the structural reality here. This is a multi-year national champion play.
The U.S. government and SoftBank are effectively partners.
They're not going to let it fail. The downside is capped by the government. And technologically, that 18A node is the inflection point. It's their chance to recapture leadership.
So the thesis is that the 2025 turnaround, that 84% gain, that was just the appetizer.
Exactly. The profit explosion doesn't happen in Q1 2026. It happens in 2027 when the foundry business matures and those 18A chips are shipping in high volume.
I agree on the long-term potential, but I have to offer a caution. Q1 2026 is going to be dead money.
That's fair.
With this guidance reset, the stock's going to be in the penalty box for a few months. This was a swing trade into earnings that just turned into a multi-year hold.
That's the reality of turnaround plays. It is never a straight lineup.
So the target horizon is a multi-year hold into foundry profitability in 2027.
Correct. You buy the fear now and you hold for the factory ramps.
Definitely not for the faint of heart, but the upside is undeniable if they pull it off.
High risk, high reward. But with the U.S. government backing that risk, the odds are skewed in your favor.
Well, there you have it. The chips are down. Literally and figuratively. Make sure you subscribe for more updates on the semiconductor wars. This story changes every week.
Thanks for listening to Investing Talk Podcast.